हेलो। हेलो। Hello. So today we'll be doing three questions. Okay, so it will be from not three different areas. Two of them are similar, but different questions from the same area. The other one will be from risk management. So we're going to do cost of capital, business valuation, and risk management. So it's from the revision kit. You can find it here. Okay. So question number 307. The first question we'll be doing is that COF company. Then we'll be doing 310, which is Zedmo company. And finally, we'll be doing 321, which is Plum company, right? So you can see they are all past papers. Like COF company is from March, June 2019. Zedmo is from June 21. And Plum is from March 16, right? Okay, so let's start with this COF company. 160. Okay. Right. So if you have the question, please read through it and try it yourself because this particular question we've already done last week also. The first part, if you see, is talking about calculating the after-tax weighted average cost of capital of COF company on a market value basis. Okay, so weighted average cost of capital, that we have already done. So try this out and then I will show you how it's done. You have the question? So if you guys have your answers, you can drop it in the chat. Okay. We read through the question. It's saying the following information has been taken from the statement of financial position of COF company, a listed company. Okay. So we have non-current assets worth 50 million. Current assets, they're saying cash and cash equivalents is 4 million and other current assets 16 million. So total assets become 70. Then they're talking about ordinary shares. They're saying the value, book value is 15 million. They're not talking about how many shares we have in issue. They're just telling me everything in issue. If you multiply it with the nominal value, it will be 15 million. Then we have reserves of 29. Non-current liabilities, we have preference shares, loan notes, bank loans, right? So usually for our question, whatever we see in the equity section and the non-current liability section is only the financial instruments. Okay. So we have the ordinary shares, preference shares, loan notes, bank loans. Those are the 4 instruments that they are using to fund this business, right? So most of the time, we will use the information from these 2 areas the most. Okay. Then we have the current liabilities and the total equity and liabilities. So now they're going to talk about each of these instruments in detail. Okay. So first they're saying ordinary shares of COF company have a nominal value of $1 per share and an ex-dividend market price of $6.1 per share. And they're saying a dividend of 0.9 per share has just been paid. Okay. So about the ordinary shares, they're telling me their nominal value, the market value, and how much dividend they paid as well. Then the preference share, they're saying the 6% preference shares of COF company have a nominal value of 0.75 per share and an ex-div market price of 0.64 per share. So here they're giving me nominal value, they're giving me market value. They haven't given me the dividend, but I don't have to worry about that because they are already telling me here it's a 6% preference share. So if I want to know how much dividends we paid for this particular share, it's 6% into the nominal value. Simple as that. Okay. Then they're talking about the loan notes. The 8% loan notes of COF company have a nominal value of 100 per loan note and a market price of $103.5 per loan note. Annual interest has just been paid and the loan notes are redeemable in 5 years' time at a 10% premium to the nominal value. So what do we know about these loan notes? As always, the loan note has a nominal value of 100. Most of the time, that is only the case. Even if they don't mention that, we can assume that. Okay. Then we know that the market price is now 103.5. Then they are telling me that it is redeemable loan notes. And when are we going to redeem in 5 years' time? How much can we redeem for at a 10% premium? Okay, so that's all they have told me about the loan notes. Bank loan has a variable interest rate. So we don't know the fixed rate of interest for the bank loan because it will keep on changing. Then they're saying the risk-free rate of return is 3.5% per year and the equity risk premium is 6.8% per year. COF company has an equity beta of 1.25 and they pay COF tax at a rate of 20%. Okay. Now, whatever you read in this paragraph is what you need for the A part, calculating of the WACC. Okay. After that, this investment in facilities clearly is something they're asking in B. So we don't have to, read that and confuse ourselves. Let's first finish off the WACC and then we'll come to this discussion because this discussion is entirely theory based and whatever we need is there in this second set, okay, in this investment in facilities section, right? Okay. So if you want to do WACC, we need 2 things, right? We need the market values and we need the cost of capital. So let me start off. It's a COF company. You're going to do the A part, right? So always clearly label in your exam also. So examiner knows what you're doing, right? So A part, we are going to do the WACC. So to do WACC, we need 2 things, right? We need the market values and we need the cost of capital. And there were 4 instruments or 4 financial instruments in this particular question. What were the four? We had ordinary shares. Then we had preference shares. Then there was a loan note. And there is a bank loan. Right? So all these four instruments, you have to find out their market values first. Then you have to find out their cost of capital as well. And then it's just a matter of using that WACC table to get the weighted average cost of capital. Okay, so this will be your structure. Okay, so now I'll give you a minute. I hope you have already done this. But in case you were stuck, this is the structure you need to have. Okay, so you need to now calculate the market value of the ordinary shares, preference shares, loan note, bank loan, and then the cost of capital for all four. And then we can use the table to calculate that. Okay, go ahead, see if you can do that. Or like market value is actually very simple. I'll give you the question. But I'm sure all of you have it, right? Okay, so if I want the market value of ordinary shares, let me read what they're saying. They're saying we have a nominal value. The ordinary shares, they have a nominal value of $1 per share and a current ex-div market price of 6.1. So the market price of one share is 6.1. If I know how many shares I have issued, I'll just multiply the two. That's the total market value of shares, right? So I know that ordinary shares, they are worth $1 nominal value. Okay, so if the book value is 15 million, that means 15 million into $1 has only given me that 15 million, right? So ideally we have 15 million shares in issue, simple, right? So let me put that in 15 million shares multiplied by the market value, which they told me was 6.1. Okay, so that will be 15 into 6.1. So $91.5 million. Okay, so that's for the ordinary shares. Then if you look at the preference shares, what are they telling me? They're saying it's a 6% preference share. We have a nominal value of 0.75 per share and an ex-div market price of 0.64. Okay. Now here the nominal value, be careful, it's not $1. So it's not straightforward. You can just say that preference shares is 6 million. Okay, because each share was worth 0.75 nominal value. So if you want to know how many preference shares you had issued, you should take 6 million, divide it by 0.75 and then multiply it by the market price. Okay, so I will do that. So the book value was 6 million. I'll divide that by the nominal value, which is 0.75. That will give me the number of shares in issue. That I will multiply with the market price of a share, which was 0.6. Let's check if it was 0.64. Yeah, 0.6. Okay, so that should give me 5.12. Right? So now let's do the loan note. Loan note also, I think they gave us all the information that we need. They're telling me it's a 8% loan note. Nominal value is 100 and the market price is 103.5. So I know that the book value is 8 million. So if I want to know how many loan notes in issue, 8 million divided by the nominal value, which is 100. Then I will multiply that with this $103.5. Okay. So let's do that. 8 million divided by the nominal value, which is 100, multiplied by the market value, which is 103. That should give me 8.28. Okay. So market value of loan notes is also done. Finally, the bank loans market value. Now remember, bank loan is not a traded instrument, right? You can't take the bank loan and then sell it to somebody else. No. If you go to the bank under your name, you have taken the loan, that is forever going to be under your name only, right? So the book value and the market value when it comes to non-traded instruments like a bank loan, it remains the same. So if they say it is 5 million book value, market value also remains at 5 million. Okay? Be fine. Okay. Right. So that is the first part where we get all the market values. So now we have the market values. The next thing is we need to get the cost of capital. Okay. Now, ordinary shares means I'm talking about the cost of equity. Preference shares means I'm talking about the cost of the preference share, the cost of the loan note or KD, if you remember, and the cost of the bank loan. Okay. Right. So if you look at ordinary shares, okay, to get KE, I have repeated this multiple times. There are different ways to do it. The first way is using what we call the dividend valuation model. Okay. The other one is using CAPM. Okay. The data that they have given me, they are talking about a risk-free rate, a equity risk premium and equity beta. Everything seems to point towards the CAPM model and not the dividend valuation model. I don't have anything to do with growth or anything to calculate, right? So most probably getting KE, I will have to do it using the CAPM model. Okay, so go ahead, see if you can get KE. And if you look at KP, there is only one way to calculate KP, so you don't have to worry about that, right? So get KE, KP, and then let's do KD as well. DVM model without growth. Because in this case, very clearly they have given me the CAPM information now. But the information is clear for the DVM without growth. True, but then we can't assume that there is no growth. There are two models. One model, you have everything that you need to calculate. Why will you go and use the other model where you don't have some of the information? What if there was growth? There is information. Now, you know CAPM, if you do, it's accurate because everything is given. So then it will be wise to use CAPM now instead of using DVM. Why will we use DVM if we are not sure whether there is growth or there is no growth? Right? No, no. Risk-free rate plus beta times. Yeah.
That means they use the answer for overall capital.
Cost of equity. Okay. So let me try to get the cost of equity first, right? So clearly I have to use the CAPM equation. So I will put that here. Right? So ordinary shares, if I want KE, that will be the risk-free rate plus beta times the risk in the market minus the risk-free rate. Okay. Now, I'm not sure if you remember this. This risk in the market minus risk-free rate, it had a special term. It's called the risk premium. Okay, so I'll just mention that here. So RM minus RF is also called the risk premium, because don't forget that in some questions they will give you RM and RF separately. In this question, they have given you the premium separately. So that means they have deducted and itself given you the answer. Okay, right. It's not ME, it's KE. Right. So let's see what the risk-free rate is. They told me the risk-free rate is 3.5%. Beta is 1.25 and the risk premium is 6.8. So they have deducted RM minus RF and given you the answer. It is 6.8. Okay. So let's put in the figures. So risk-free rate was 3.5%. Plus beta, which is 1.25. Multiplied by the premium, which is 6.8%. That will give me KE, which is 12. Okay, so let me just put KE equals to okay, so I'll bold that because I need that figure. Okay. So next, let's do preference shares. There's only one way to get the cost of preference shares. That is using the dividend valuation model, right? So KP should equal to the dividend divided by the market price of a preference share, right? So if you look at the dividend of the preference share, although it's not given to me directly, they told me something, right? They told me that it was a 6% preference share. So if I want to get the dividend, I will take 6% and multiply it with the nominal value. They told me that nominal value is 0.75, right? So 6% into 0.75 is the dividend and the market price is already there, 0.64. Okay, so I'll just do that and get the cost of the preference share as well. Okay, so KP, if I want the dividend, I should take 6%, multiply it with the nominal value, which is 0.75. See how much that is. 0.045 and P naught, we already know the market value. Exactly. Okay, so P naught, we already know it was $0.64. So I'll just put that. Okay. So then if I want KP, what I will do is the dividend, which is 0.045, I will divide it with 0.64. And of course, multiplied by 100 and give it as a percentage. So that will be 7.03%. Okay, so that is KP. So next thing is we need to get KD. It's a redeemable loan note. So I hope you know it should be a IRR style calculation, right? So I'll give you some time to do that. Take it down if you haven't and then can do the loan. Okay. Right. So now we need to do an IRR style calculation for the loan note. So they're telling me 8% loan notes. They have a nominal value of 100. Market price is that. Okay. So if you are doing an IRR calculation, you need the market value, you need the interest post tax, and you need the redemption value. Okay. So market value clearly it's 103.5. So I can use that. Interest, I know it's a 8% loan note, right? So it's 8% into 100, but I have to account for it after tax. So we need to make that adjustment, which we will do. And finally, redemption is at a 10% premium. So we will redeem at 110, not 100, 110. Okay. So right, let's do that. So we have the market value, which is 103.5. Then you have interest times 1 minus t. Okay. So I know that I'll do the interest component over here. So I know that the interest was 8% into 100. So that will be 8 multiplied by 1 minus the tax rate, which was 20%. Okay, so interest will be 6.4%. Sorry, $6.4, right? That will be here. Okay, I'll just push this a little bit here. You don't have to show the examiner the working. I'm showing it so you don't get confused, okay? I'll just put it on the side again. And then finally, redemption. Redemption was at a 10% premium, so 110. Okay. So now we have all our cash flows. Now it's a matter of getting an IRR. So to get IRR, what should you do? You should take two separate rates. Okay. So let me use 5% and 10%. The discount factor at 5%. Here it's always just 1. Interest, they told me that this was going to happen. I didn't put the years, so let me quickly put the years as well. Market value happens in year naught. Interest, they told me it was going to happen for, it's a 5-year redeemable loan, right? So from year 1 to year 5, it's going to happen. Redemption will happen only in year 5. Okay. So if you take year 1 to year 5, you have to take the annuity factor. Okay. So 5% annuity factor will be 4.329. And year 5's discount factor will be 0.78. So you can get the present value at 5%. Figures. Right. So let me take it to 2 decimal places. Okay. The same thing you need to do for another discount rate. So maybe you can use 10%. Okay. The discount factor at 10%, present value at 10%. This will be 1. And then if you look at annuity factor at 10% for 5 years is 3.791. And the discount factor will be for 5 years 0.621. So multiply the cash flow with the discount factor. And you can take it to 2 decimal places. So let's take the NPVs as well. It's the total of this column. Okay, that is the 2 NPVs. Take it down, haven't. Then we can do IRR. Okay, so to get IRR, we need two rates, that is 5% and 10%, and two NPVs, which is 10.45 and a negative 10.93. Okay, so just a matter of putting this in the equation. Low rate is 5 plus NPV at 5 was 10.45 divided by, again, NPV at the low rate 10.45 minus NPV at the high rate, which is a negative 10.93. Multiplied by the high rate, which is 10, minus the lower rate, which is 5. That should give you IRR. So IRR is only KD, which in this case will be 7.44%. Okay. Now, for the bank loan, guys, usually they will tell me the interest rate is 5% or 10% because it's a bank loan, right? It's given to you directly by the bank. So the rate is usually fixed. But in this case, if there's a small problem, and that is that they're telling me that the bank loan has a variable interest rate. So just because it's variable in nature, I can't just forget about it. So the only closest thing I can do is assume that the cost of capital for this bank loan is the same as the cost of capital for the loan note. So the loan note I have calculated, it is 7.44 no KD. I will have to assume that for the bank loan also it will be 7.4. Okay. So I will put that here, 7.4. Otherwise, usually it will be given directly. If it's not, then you have to make this assumption. Right? So that's it. Now it's just a matter of getting the weighted average cost of capital. So what do you need? You need the market values, which we already have. Okay, then you need the cost of capital for all our instruments. So ordinary shares, preference shares, loan notes, and the banking. Okay. So ordinary shares we already had. Let's copy everything. All the market values are there. Okay. And the cost of capital for ordinary shares, KE was 12%. Then for preference shares, it was 7.03. And then it was 7.4 for KD. Okay. So now what you have to do, you have to take the market value and multiply it with the cost of capital. Okay. So this is the normal WACC table. I'll give you a minute. See if you can complete it. Right, so let me do the multiplication. Market value into cost of capital. Okay, so if we take everything to maybe 2 decimal places. Okay. So now what you have to do, you have to take two totals, right? One under the market value column. So let's take a total here. One under this column. Okay, so now if you want WACC, to be this figure 1232.8 divided by this figure 109.9. So that will be 11.217. So let's just take it to 2 decimals. That will be 11.22%. That's it, highlight it so it's easy for your exam. Right? So that will be it for the calculations. So now let's read the B part. They're saying discuss the views expressed by the 3 directors on how the investment should be financed. They're talking about some investment. They have information there. Read through it and just, give your opinion about what you think they're saying. Okay, so read through it first and then we'll discuss. They will take upset. They won't not take the bank loan. They will take it because that is also an instrument. But there won't be any calculation because already they will give you the interest rate, 8% or whatever, very direct. Okay, right. So investment in facilities, what are they saying? Corp Companies Board is looking to finance investment in facilities over the next 3 years, forecast to cost up to 25 million. So they need 25 million as an investment. The board does not wish to obtain further long-term debt finance is also unwilling to make an equity issue. So they don't want to issue shares, they don't want to take a loan. This means that investments have to be financed from cash, which can be made available internally. Board members have made a number of suggestions. So Director A is saying, company does not have a problem with funding new investments as its cash available in the reserves is 29 million. If extra cash is required, they can reduce its investment in working capital. So if you look at what he's saying, yeah, the reserves are there, 29 million, but they are not saying cash is 29 million, right? Cash, if you see, it's only 4 million. So what he's saying there is wrong. The reserve entire is 29 million, but cash alone we only have 4 million. So what he's saying doesn't really make sense. Okay, so you just need to mention that. B is suggesting to sell a building for 20 million. It will raise a large one-off sum. So if his calculation is correct, it's fine. But then again, there is a problem here. What's the problem? There is a rent that's going to get added now. You'll have to find other buildings for rent. So how feasible is that for you? You have to talk about that as well. Okay. And then Director C has commented that although a high dividend has just been paid, dividends could be reduced over the next 3 years, allowing spare cash for investment. So he's saying now you're paying high dividend, reduce it in the future. But we know that usually shareholders, if there is a pattern for dividend, they will expect that same pattern to be there. So suddenly, if you're going to reduce it, they might start questioning, okay, why did you pay the high dividend in the first place? This year itself, you could have invested. No, why did you pay extra? They will start thinking that you're not doing well as a company. So you need to talk about that in the third part. So 3, 6, 9. So for each director, if you can make 3 points, you will get your 9 marks. Okay. So have a look at that answer. They have very clearly told you what they expect from you. So you can read through these answers and learn how to answer these theory-based questions. This one in particular is very simple. Okay, because everything that you have to put in this is there in the question itself. Okay. Right. So that is for company. Now let's do Z. Yeah. Read through it and the requirement. I'll just go through the requirement. Using the capital asset pricing model, calculate their current cost of equity and project specific cost of equity suitable for the new venture. So they want the KE currently plus a project specific cost of equity as well. So most probably they are going to invest in an area of business where they are not currently in. So that's why they need a project specific cost of equity, right? Right. Have a go, read through it and try here. Now this question, guys, ZMO, if you see, out of 20 marks, only 6 marks they have given for calculations. Okay. The remainder of the marks, 14, is just for theory, right? So that's the importance of writing something, right? Now, I'll say this now. Make sure you remember it in your exam as well. When you're writing theory-based answers, first of all, make sure you write short sentences, not too long, right? Don't write 1 point for like about 5, 6 lines. Examiner won't have time to read everything. Okay. So if you're making now, if there are 2 marks, ideally you should make 2 points. Okay. Now if there are 6 marks, either you have to make 6 full points or 3 points explained, right? So usually what I give as a guide is, if it is less than 5 marks, if the question is asking for something less than 5 marks, then what you need to do is give 5 points. So 4 marks means 4 points, 3 marks means 3 points, right? If it is more than 5, say it is 6 marks, then chances are that you have to give half the number of points but explain them. So 6 marks means you have to have 3 separate points, but each point has to be explained. So mention it and explain it. So if you had 9 marks, like for example, previously there were 9 marks, I told you 3 marks each. You can't make 9 points. No, it doesn't make sense, right? So usually when it is more than 5 marks, there will be explanations involved. Okay. So wherever you see a question where they're asking for theory, make sure that you make enough points so the examiner has something to mark. If you're not going to write anything, he also can't help it. No, he can't give you even a mercy mark. Right? So always make sure for theory-based answers, especially, you write something. Whatever comes to your head, write. Examiner doesn't know who you are. He doesn't know how you look like. Even if you write some silly point, doesn't matter. But whatever comes to your head, just keep writing it and go. Okay? I guess what you need is actually here. To do both current cost of equity plus project specific cost. Right, so hope you got those figures. So let me quickly get it for you. So using capital asset pricing, they're asking for the current cost of equity and project specific cost of equity, right? So let me read through it first. It's saying ZMO company is a listed company in the house construction industry. Okay. Over the past 5 years, results have been disappointing, and as a result, share price has fallen. Okay. So from 3.5, it has become 1.05. The deterioration in the performance and share price has been accompanied by an increase in financial gearing to a high level. Fine. So they're giving me the equity, the long-term liabilities and all that. Then they're saying ZMO company's loan notes are quoted at 65 per loan note, and both the loan notes and bank loan are secured. We have an equity beta as well. So if you want to get the general KE, we need to use this equity beta and we need to use the risk-free rate and the market return as well. That's also given 10%, right? So let's go ahead and get that first. ZMO company. Right. So first, let's get the capital using CAPM. We are going to get the current cost of equity. So KE would equal to risk-free rate plus beta times return in the market minus risk-free rate. Right. So if I look at the question, risk-free rate, they're telling me it is 4%. Beta, they told me it's 2.3 and market return is 10%. So risk-free rate is 4%. Beta, it's 2.3. Multiplied by return on the market was 10% minus risk-free rate, which is 4%. So that should give me KE as 17.8%. Yes, that was straightforward. Now we need the project specific cost of. Are you doing the exam in December, right? Because I can see your name. Did you pay? You paid, right? Okay.
My name is.
No, thing is, they gave me a list. It's not the total list. Anyway, I will check once. Okay. Right. So project specific cost of equity, right? Now, I have explained this before. I will explain it once more. If you look at this company, they were in but house construction. Okay. Now they are telling me that over the past 5 years, things are not doing so well in this particular industry, right? So now what are they trying to do? They are trying to invest in something new. Okay. So they are saying to improve performance, ZMO is considering the construction of commercial properties such as office blocks and industrial complexes. So earlier they were only doing house construction. Now they are going to go for industrial complexes also. This is a new activity for ZMO and it's expected that the risks involved will be different from its current activity. The financial director has proposed that a project-specific discount rate should be used to appraise the new venture, but the commercial director doesn't feel that it's necessary. So finance director is saying we need to have a project-specific rate, whereas the commercial director is saying that's not necessary. Okay. Now they're talking about another company, Winston Commercial Properties, undertakes commercial construction projects similar to those being constructed by ZMO company. That company has an equity beta of 1.25. They have 100 million ordinary shares in issue, quoted at 2.6 per $1 nominal value ordinary share. They also have 110 million of loan notes, quoted at 96 per $100 nominal value, and both companies pay tax at 20%. Okay. So the situation is this. There is a company, they are called Zedmo. Okay. They were in house construction. That's not a problem. Now, if you take this house construction industry, guys, there are two types of risk that they have to face. One is they have to face the business risk. Business risk means maybe when it comes to house construction, suddenly people will change the plan. Suddenly people don't have enough money to pay. It will stop those kind of risks when it comes to house construction. Then there is the financial risk that is to do with the debt equity structure of this particular company Z, which is the company we're talking about. Okay. Now, what's the problem? After this, they are going to go into industrial construction. So, they are not going to stick to house construction. They are going to move into industrial construction. Now, here, the business risk is also there. The financial risk is also there. But business risk may be different, obviously. When it comes to industrial construction, maybe the risk will be not getting like, past, whatever, usually the building will be tall, no? So most probably not getting like a COC or something like that, right? So the risk wise, it's going to be different for this particular industry compared to this business risk, right? Financial risk for Zedmo will be the same. So now the thing that we have to do here is we take a similar company, that is only this WCH that they're talking about. So they are a similar company who is already in industrial construction. So what do? We take their equity beta. Okay, we take the equity beta. Equity beta reflects both business risk and financial risk. What we will do is we will de-gear it to remove the financial risk, and we will re-gear it to bring in our financial risk to the business risk of the industrial construction. So what happens when we are de-gearing? We remove WCH's financial risk. When we re-gear the new equity beta, it will have the business risk of industrial construction and the financial risk of our company, which is Zedmo company. Okay, so that's what we're trying to do in the project specific cost of equity. Okay, right. So let's do that now. So first thing that we need to do is we need to take the equity of WCP company, right? So WCP, they're saying it has an equity beta of 1.25. So first let me de-gear this equity beta. Right? So how do I do that? There is an equation. You don't have to memorize it. It's already given in your exam. Goes like this. Beta asset. So when I de-gear, the equity beta becomes an asset beta, right? So beta asset should equal to the value of equity over the value of equity plus the value of debt times 1 minus T multiplied by beta. Okay. So beta asset is what I want to find. Right. So if you look at the value of equity for WCP company, let's have a look. They're saying we have an equity beta of 1.25. We have 100 million ordinary shares quoted at 2.6 per $1 nominal value. That means we have 100 million ordinary shares. Each share is worth 2.6. So that is only the value of equity, right? So 100 million into 2.6 value of equity. So divide that by again value of equity. So that is 100 million into 2.6 plus the value of debt. So what are they talking about debts there? They're saying company has 110 million loan notes currently quoted at 96 per $100 nominal value. So I know that the value of the loan notes is 110 book value. So I'll divide that by 100 to get the number of loan notes I've issued and multiply it by 96. Okay. So that will be 110 divided by 100 into 96. So that I have to multiply it by 1 minus the tax rate. Tax rate is 20%. Okay. Then this whole fraction, I'll multiply it by the equity beta of WCP company, which is 1.25 given to me in the question. Okay, so put this in your cal, you will get beta asset. Yes, well, post-tax fee. Okay, if you're talking about cost of debt, because we're talking about the company, so company always gets a tax benefit, so you have to take the post-tax. Okay, put it in your cal, you should get your beta asset as 0.9. Okay. So now we have beta asset. Now we are going to do the re-gearing. So re-gearing means what you have to do? We take this beta asset and put the financial risk of our company into it and get the new beta equity, right? So same equation has to be used. I'll copy it down again. So I'm going to re-gear. Beta asset equals to value of equity over. Okay, so now I know the beta asset, which is 0.94. Okay. Now careful here, when you're taking value of equity in this case, you shouldn't go and take the other WCP's value of equity, right? We have to take ZMO's value of equity. So 0.94 should equal to value of equity in our company. So let's go there. You can see it's 40 million, but the nominal value is 0.5. Okay, so 40 divided by 0.5 will give you the number of shares I have in issue. How much is the price of one share? They are already telling me at the top itself. They're saying it is now $1.05. Okay, so I will get that. 40. First, I will divide it by 0.5, multiplied by 1.05. So same thing here also. You can get the answers, right? I'm just putting the workings. And if you look at value of debt, what are they telling me? They're telling me that we have loan notes and there is a bank loan. So value of debt has two components, right? So if you take the loan note, they're saying it's 250 and the nominal value is $100 and it's quoted at 65 per loan note. Okay. So I can get the value of the loan note first. So I'll take value of loan note. Book value was 250. I'll divide it by 100 and multiply it by 65. So that will be the value of the loan note, which is 162.5 million. And then if you take the bank loan, the value will be there given to you directly itself. It's 20 million, right? So just add that as well. So total value of debt will be 182.5. So that I can put it here, 182.5. Don't forget 1 minus 20%. Okay. Should be multiplied by the beta figure. So now you have to work backwards because now we need to find this beta equity figure. Beta asset is already there. Okay. So what you can do is first put the entire fraction into your cal, get that answer, and then take 0.94 and divide it with that answer. You'll get beta equity. Okay. You should get beta equity as 2.57. Okay, so we have beta equity. So now if you want KE, just use the same CAPM equation. But this time we will change. Obviously, we will use the new beta equity that we calculate. So project specific cost of equity is going to be the risk-free rate, which I think we already had 4%. Plus beta, which is 2.57, which we calculated now, multiplied by 10% minus 4%. Okay, so project specific cost of equity will be 19.4. Okay. Right, so what did the question ask? They asked me for using CAPM to get current cost of equity, project specific cost of equity. So that part is fine. Second is saying, referring to your calculations, comment briefly on the view of the commercial director. Now, what did the commercial director say? If you look at the first paragraph, third line, it's saying, the financial director has proposed that you have to use project specific rates, whereas commercial director is saying no need. Okay. So if you look at our calculation here, when we didn't use a project specific rate, our KE was 17.8%. So we are expecting our shareholders to be happy with a return of 17.8%. But when we did the project specific rate, we realized that it is 19.42%. So what the commercial director is saying is not correct. He's saying use the old rate, it's fine. But actually speaking, the shareholders maybe, what is it? Industrial construction, right? Maybe that particular industry is more risky. So what happens is our shareholders, if we are going to move to this new industry, they will start demanding a higher return. So commercial director telling us to use that 17% is not actually very accurate, because we might do all our calculations based on that. But in reality, what we have to give our shareholders is actually much more. Okay. So financial director, what he is mentioning, use the project specific rate is actually a more accurate method to go about the situation, because the industry is different. Okay. So that will be your comment. Right. Then B part is saying, discuss 3 problems ZMO may be facing as a result of its current high level of gearing. So let's look at the debt. Yeah. If you look at the share capital, it's 40, retained earnings 35, debt is 250. Pretty high, right? So what do you think is a problem of having too much of debt? Whatever comes to your mind, you can just pen it down. What do you think will be the risks? I'll give you a minute. It's for how many marks? 6 marks. So see 3 problems. So one, you mention the problem and explain. What do you think will be a problem if you have too much of gearing? Correct. So one problem, Hari is telling, cost of equity is going to increase. Why? Because the shareholders will perceive the company as risky. So if they want to come and invest, they will start asking for a higher return. So that is 2 marks then. What else can be a problem?
Will be the suppliers or vendors. There will be difficulties in working capital.
Yeah. So now if you have a lot of debt, what you're trying to say is you have a fixed payment of interest which we can't avoid, right? So what happens? The earnings volatility or how much your earnings can fluctuate, it becomes higher. Why? Because even if you make a lower earnings, this interest is fixed. So what happens? The amount that you have to pay your suppliers, the amount that you need for working capital, all of that, it's going to become uncertain. So that is also another problem that you have in the gearing is high. What else? Bankruptcies, yeah, in case you default on interest payment, the bank might force you to liquidate. Anything else? 3 points are enough. One more thing is, in case you want more finance, since you're already heavily in debt, banks may not be willing to give you. Okay, so that's another problem, right? So if you can mention that, you will get an easy 6 marks there. Then C is saying in respect of both equity and debt, discuss the risk-return relationship and how it affects ZMO company's financing costs. So they're asking you to discuss the risk-return relationship and how it will affect their interest or their financing cost. What do you think you can say there?
In the risk and return is the high risk, the high return will be get. In the low risk, low return will get. Due to the company is in the high gearing position, the equity holders will get the will request for the high return. That is because it's high risk.
Okay, right. Anybody else? So the main point you have it there. If the risk is high, the return is high. They will expect a higher return, right? So in this case, because anyway the risk is also high because of the debt, equity holders will also expect that same thing, right? Anything else you can think of?
Answer is quite something.
That is 2 marks. Okay, so I'll show you if you want. 499. No? So if you're talking about a 6 marks, wait, I'll show you. So see, the first point that they have mentioned their risk-return relationship, that's what you mentioned. Risk-return relationship explains why different sources of finance have different costs. Investors' required rate of return is determined by the level of risk. If it's high risk, then they will require high rate of return to compensate for that risk. Investing in low risk means low return is fine. Okay, so that will be 2 marks. Then if you talk about this particular company, they're saying the equity holders have no guaranteed return because ZMO has no obligation to pay a dividend and capital growth is also not guaranteed. So that is something that we have to identify, right? Now, usually if you're an equity holder, why is your risk high? One, yeah, debt is high. The other thing is nobody is telling you for sure I will pay you this much dividend, right? So because of that, only usually cost of equity is higher than cost of debt when we compare. Okay, so that's the first point they're saying. When you compare that to lenders or loan note holders and the bank, they have lower risk. Why? Because interest is compulsory. Equity holders dividend is not compulsory, whereas interest is compulsory. Whether you like it or not, you have to pay. So that's why the bank and the loan note holders, they tend to have a lower risk than equity holders. So they're mentioning that. Then they're saying one more thing in this particular question, loan note and bank loan both were secured on their assets. They mentioned that you have to read it and see. They said the loan note and the bank loan both were secured, meaning in case you don't pay interest, your asset can be taken by the bank. So again, now their risk is low. Okay. The above effects can be seen in their finance cost when it comes to cost of equity being higher than the cost of debt. So if you really see when we did the calculation, if we go there, if you look at the cost of equity, it's actually pretty high, right? It's around 17.8%. Whereas if you look at the debt cost in the question, if you see, I'll just tell you how much it was. Yeah, so if you look at the bank loan, it was 7% and the irredeemable loan notes was close to 6.5%. So you can see cost of equity is so much more higher, 17%, 19%, mainly because of that reason. Why? Because loan note holders risk is low, so the return also is low. Whereas when it comes to equity holders, it's the other way around. Got it? So you just need to mention that you will get your 6 marks. But what you have, what I just read now is about 8 marks. So if you can mention the risk return and somehow explain why equity is higher than debt, that should give you your entire. Okay. Right. So that's it for ZMO, right? So I'll quickly take attendance and then we'll take a break and come back and do plan. See who's here. Parcels again. Okay, Shilpa and right. So quickly take a break, 20 minutes and come back. Okay, so come back at 10:55. Okay, so Afsal, you're asking me if it will be made clear whether they want cost or required return. Yeah, because usually, but to be honest with you, usually we are talking from the company's point of view, right? Because the cost to the company and the required return to the investor will be the same most of the time. The only difference is this cost of debt, because when it comes to cost of debt, what happens is the company can include tax benefit, whereas for the investor, the tax benefit won't be there, right? But most of the time, like I said, we are talking from the perspective of the company and not the investor, because we are financial managers for the company, so we will be talking about the cost of our capital and not the required return most of the time. Okay. Right. I'm sorry, I think I said 10:55. That is like half an hour. Anyway, it's fine. Those, since most of you are back, please go through Plan Company now, read through it, and we will work through after about 5 minutes, right? So this is from risk management, right? Now the examiner has specifically mentioned that section C will be from investment appraisal, working capital management, cost of capital, as well as business valuation. But once in a way, you see, this has a little bit of risk management also. Okay, so that's why I say don't always go by the book and think, okay, this shouldn't come in this section, that should come in this section, because it's up to the examiner. If he wants, he can put something for 5 marks and ask you a question. After that, you can go and fight with him at that point, right? So now this is an example where risk management came a little bit in section C. Okay, right. So have a look at what it says, Plan Company. Okay, so guys, one more thing, the plan. Next week, again, we will be doing more questions. Week after that, we will have a mock exam. Okay, so please make sure that you're ready. You have 2 weeks now. You can't be playing that mock exam because that is November 30th, right? So after that, you only have 1 week for your actual exam. So the marks that you get there will be a very good indication of what you can expect in your real exam. Okay, so I'll get the dates right. Today is the 16th now. So 23rd, again, we will be doing more revision. 30th, we will do the mock exam. Mock exam, we will be doing it online. Okay, since most of you are anyway not coming. On the 30th, it will be online from 8:30 to 11:30, 3 hours. And please send me your answer sheets on, email to me. I will get back with your marks on the same email ID, right? So if you send me a message, I will send back your marks on that. The paper that I will give you, you might not require I will tell you how to get the proper answers for that paper, right? But in case you need, if you have doubts or anything, you can always reach out to me. That's not a problem. But on the 30th, I expect all of you who have, enrolled for exams in December to send me your answer scripts, right? So if I'm not mistaken, I'll be expecting about 6 to 7 answer scripts. Okay. So email them to me on the 30th. I will anyway have the class online. So if you have questions, you can always ask. And I will get back to you within a day or so. So if you can send it to me on Saturday itself, by Sunday, I will send back your marks. Okay. Okay. So it says here, the directors of Plan Company, yeah. The directors of Plan Company expect that interest rates will fall over the next year, and they're looking forward to paying less interest on the company's debt finance. Okay, now think of it logically. Okay, they have debt, they are expecting the interest to fall, right? Now, this will be a benefit only if they have variable rate interest loans. If they had loans where they have to pay fixed rate, whether the interest rate is falling or rising is not going to impact the interest, they will have to pay a fixed percentage, right? So if they want to benefit from the fact that interest is actually dropping, they need to have variable rate loans. Okay, so keep that in mind. The dollar is the domestic currency of Plum Company. The company has a number of different kinds of debt finance as follows. So there are loan notes, two types of loan notes, a bank loan and an overdraft. Okay. So if you look at the first loan note, denomination, they have taken it in dollars. Nominal value is 20 million. Interest rate is 7 per year. Interest type is fixed. So if you look at this particular loan note, whether the interest rate increases or decreases doesn't matter because the rate is fixed. Okay. Interest is due in 6 months time and redemption is at 8 years time at the nominal value. Okay. Then there is another loan note. Denomination is in pesos. Now for some reason they have taken it in a foreign currency. Okay. Nominal value is 300 million pesos. Interest rate is 10% per year. Again, fixed rate, 6 months time. Redemption is 8 years time at nominal value. Bank loan, dollar 4 million, 8% per year. Here you can see it's a variable rate. So the fact that interest rates are dropping will actually benefit the company for the bank loan. Okay. 6 months time, interest is due and redemption is in installments. Finally, the overdraft, it's in dollars again, nominal value 3 million, 10% per year again variable, interest is due monthly and redemption is continuing at the current level. Fine. Then they're saying the 7% loan note was issued domestically while the 10% loan notes were in a foreign country. Clearly, one is in dollars, other one is in pesos. Dollar is their currency. The interest rate on the long-term bank loan is reset to bank base rate plus a fixed percentage at the end of each year. So that's how the variable rate is calculated. The annual payment on the bank loan consists of interest on the year-end balance plus a capital repayment. Fine. Then they're giving me the exchange rate. They're saying the spot rate pesos to dollars, 6 months forward rate pesos to dollars. Plan company can can place pesos on deposit at 3% per year and borrow dollars at 10% per year. The company has no cash available for hedging purposes. Fine. Requirement, evaluate the risk faced by Plan company on its peso denominated interest payment in 6 months time and advise how this risk can be hedged. Okay. So what's the problem here? You can see that there is a 10% interest that has to be paid on 300 million pesos, right? So that 10% basically you're going to pay it only in 6 months time. So the problem is what in 6 months time, if the exchange rate moves unfavorably, you might end up paying more or less. So that's the issue, right? So mention that as an issue and you need to say, how am I going to hedge this? How will I hedge it? Either I will go for a forward, they have given me the forward rate, or I can go for a money market hedge. Those are the only two options that I have, right? So if you can mention that this is the risk and how do you hedge the risk and the two methods, that is basically your 5 marks. Okay, so have a go at it, mention the risk and do a forward as well as a money market hedge, and then you can, basically choose which one is better for the company. Okay, quickly finish it off. Okay, so let me mention the issue first. Okay, so the peso denominated loan, right? So there was an interest to be paid in pesos in 6 months time. How much was that? Let me see how much that was. 10% of 30 million. So I'm talking, sorry, 300 million. So I'm talking about 30 million pesos that has to be paid. Okay, so interest to be paid in 6 months time. So this is the transaction that I'm trying to hedge. Okay. So now if I look at the spot rate, if I was to do this transaction today, how much will it cost me in dollars, right? So if you look at the spot rate, they told me it is 58.335 to 58.345. Okay, so now in this case, we are going to pay pesos, meaning we have to buy the peso from the bank because we don't have pesos with us, right? So meaning the bank is selling pesos to us. They always sell at the lower rate. Okay, that will be 58.335. Okay. So in dollars, I will have to pay today. If this transaction happened today, I will have to pay 30 million divided by 58.335. So that will be 514271. Okay, so today if I did the transaction, I will end up paying 514,271. Okay, right. So let's see what happens in 6 months' time. Now, if you look at 6 months' time, what has happened? We don't have the predicted spot rate, but we have the forward rate, right? So we can make an assumption that both are more or less the same. So what happens in 6 months' time? The rate is going to become 56.585. Okay, so that means how much will I end up paying in dollars? We need to calculate, right? So payment in 6 months' time, that will be 30 million pesos divided by the rate was how much? 56.585. Okay, so in dollars, I'm talking about 530,176. Okay, so you can see what is happening is if you did the transaction today, it will only cost you 514,271. But because the transaction is happening in 6 months' time, there is going to be an increase in how much you will have to end up paying. So that will be, there is an increase in cost of how much? 530,176 minus 514,271. $15,905. Okay, so that is only the problem that this company is facing, right? So increase in cost of 15,905. Okay, right. So to hedge this risk, keyboard is not working. Okay, to hedge this risk, the company can either opt for a forward exchange contract or a money market hedge. Okay. So if you go for a forward, what will happen, right? So if you're going for a forward exchange contract, what will happen? The entire 30 million pesos, you will fix the rate. Okay. So what will be the rate? The forward rate is the same, 56.585, right? So you will end up spending a fixed amount of 530,176, right? So you can see forward exchange contract means this only will be the transaction. Okay. If the company enters into a forward, will fix the amount that will be paid in 6 month time to 530,176. Okay, so that's one option you can go for. The next option is you need to go for a money market hedge. Okay, so I'll give you a minute. Quickly do the money market hedge. I know it's only for 5 marks, guys, but in this case, they have kind of simplified the money market hedge also because they have given you peso deposit rate and dollar borrowing rate, first thing. Usually they give you 4, make you choose. Here they have given you exactly what you need, first thing. Next thing is for the forward as well as the, the prediction. You can see this particular calculation, it's repeated now twice. So because of that also, they don't have to give you the mark 2 times. So that's why although you might feel that there is a lot going on, the marks is a little low for this particular question. We can't help it. Okay. Right. So take this down and then do the money market hedge. Right. So if I was to do the money market hedge, okay, so in 6 months' time, what's going to happen? I need to have a payment. So a payment of 30 million peso. Right. So if I'm going to pay in 6 months' time, what do I have to do today? Payment is a liability, right? So today I have to do the opposite. I need to create an asset. Okay, so today I will create an asset. So two things can be done. Either you can deposit or you can borrow. If you borrow, you're creating a liability. So I have to deposit. Deposit rate, they had already given to me. They told me peso on deposit is 3% per year. So I'll just take 3%, but half of that, 6/12. So I will only take 1.5%. So what's going to happen today? I will deposit the present value of 30 million pesos. So 30 million divided by 1 plus 3% into 6/12 will be 1.5%. So I will end up depositing 29,556,650 pesos. Okay, that's how much I will deposit. Okay, but again, I am a US based company. I can't deal with pesos. So what I will do is I will convert this at the spot rate. Okay, so in the question, they had given me the spot rate already. So let me go there. Right. So if you look here, the spot rate is 58.335. Okay. So I will take the 58.335. Okay. And I will convert this peso figure to dollars. Okay. So when I do the conversion, it will be 29.556650 pesos. I will divide it by 58.335. So in dollars, how much will that be? 506,671. This is 59 million. Okay. So come on. So that's it. I have converted it to dollars. Now what do I have to do? I have to check what happens in 6 months' time. So I will do that as well. Okay. So I'm telling to deposit 506, but we don't have 506,671. So I will borrow. The borrowing rate they have given to me in the question. They're saying the company, 3% per year and borrow dollars at 10% per year. So 10% is the rate. But remember, into 6/12, right? So now if you want to know exactly how much you would end up borrowing, it's going to be 506,671 into 105%. That is 100 plus 5% because 10% has to be divided by 2. Okay. So ultimately, you end up borrowing 532,000. Okay. So what happens if you do the money market hedge? Okay. If you do the money market hedge, to pay this 30 million pesos, you will end up spending $532,005. Okay. Now compare that with the forward. In the forward, you ended up spending 530,176. Here it's 532,000 also. Clearly, you will go for the forward exchange contract because you end up spending less dollars when you use the forward. Okay. But you need to mention all of this as well because the examiner has to know how you arrived at that conclusion. Okay. Right. So that's that. Yeah. The thing is this money market hedge, not all companies can do. If you're a company who has the capacity to borrow, say for example, you should be able to deposit in pesos. Now, if I'm in Sri Lanka, do I have a choice? Can I go and deposit in pesos is a question. So not everybody can do a money market hedge. Whereas a forward, everybody can easily do. It's just a matter of going to the bank and fixing the rate. That everybody can do. This, not everyone can. So in case they ask for limitations, money market hedge, that is one of the biggest limitations. Okay, so that's the money market hedge, right? So I do agree. Sometimes you might feel that, it's a little too much work for 5 marks, but what to do? Right? Sometimes in section C, you end up having to do a lot of calculations. So that's why I always say theory only, the time and the marks will kind of match. Whereas calculations, you might do a lot of work and then they will only give you like 5, 6 marks. Can't help. Okay. Right. Then they're saying identify and discuss the different kinds of interest rate risk faced by plan. Okay. Now, when I look at the marks again, 5 marks, I don't think from this question I can make 5 points. Okay. So chances are that in this case, I have to make maybe 2 to 3 points and explain because I can explain. Okay. So what's the interest rate risk here? The first and obvious risk is there are certain loans that are fixed rate loans. Okay, and the company is predicting that the interest rate will drop. So then the issue is what's going to happen? You will not be able to take advantage of any interest rate drops because we do have fixed rate loans. That's the first thing. Okay. Then the other thing is there are variable rate loans also. So then there is a risk that there will be a variation. So we can't predict exactly how much our interest rate cost is going to be. So that's the first problem. Okay. Then there is another problem that it's not the case in this company, but they've mentioned it in the marking scheme. So I'll just talk about it. It's called that basis risk. Okay, so certain cases are there where the company will try to match the assets and liabilities. So if there is an interest-bearing asset, they'll try to match it with the liabilities. But sometimes it will not be 100% match. Because what we have to pay and what we are going to receive as interest, it doesn't match 100%. So that is another risk. But in this particular company, there doesn't seem to be a situation like that where the assets and the liabilities are matched. They've just mentioned that and said that in the question, it's not there as well. Okay, so that will give you your 5 marks then. Now, C part, guys, is very interesting. Okay, because it has nothing to do with now risk management, right? They're talking about cost of capital in this case. They're talking about the loan note, right? So they're saying the dollar denominated loan notes each have a nominal value of 1,000. Now, usually loan notes, what's the nominal value? 100. But in the question, if they say it's 1,000, you have to believe them. Okay. So in this case, actually it is 1,000. Fine. And it is convertible. So it's a convertible loan note. So they're saying as an alternative to redemption in 8 years. So if you look at the dollar loan note, this first one, you're supposed to redeem in 8 years time at nominal value at $1,000. You're supposed to redeem. But they're saying you have another option because it's a convertible. You can go ahead and as an alternative, the loan notes could be converted to 110 ordinary shares. Okay, so it says as an alternative to redemption in 8 years, the loan note holders could after 7 years convert each loan note into 110 ordinary shares of PLAM company. The ordinary shares of PLAM are currently trading at 6.5 per share on an ex-div basis. Current cost of debt is 8%. Now they are asking you, justifying any assumptions that you make, calculate the current market value of the loan notes of PLAM using the future share price increases of 4% and 6%. So what they're trying to say is this. You can either redeem. If you redeem, you will redeem at 1,000. That's it. Or you can convert, meaning you can, instead of taking the cash for the loan note, you can ask for shares. But when will you ask for shares? Only if the amount that you get from the shares is more than the amount of redemption. So amount that you get from the shares is determined by the share price. So they're saying in one situation, share price has increased by 4%. In another situation, it has increased by 6%. So whenever the amount that you get from the shares is more only, you will go for the conversion option. If not, you will stick to the $1,000 redemption itself. So they're asking you, consider whether I'm going to redeem or whether I'm going to convert. And after that, calculate the market value of these loan notes. Okay. So I'll give you a minute. Try to think about it. It's a convertible. If you want, look back and see how we did the calculations. And then we will see how to deal with this. But there is a small catch in this question, that is, redemption happens in 8 years, whereas conversion is happening in 7 years. That's not normal. Because normally redemption is 8 years, means conversion also they will tell do it in 8 years time. But here for some reason they're saying 7 years. So there has to be some sort of adjustment that has to happen there also. Okay. So I know this is tricky, but I deliberately choose this question for every TRG because if you know how to do this, you can kind of nail this convertible loan notes situation. Okay. So have a go. Don't be scared. Just, whatever comes to your mind, do it and then we will see how to correct. Okay. So let me go through what they're saying, right? So now I have to decide the market price of these loan notes, convertible loan notes, if the share price increased by 4% per year, right? Now, if it is convertible, the first decision I have to make is, am I going to convert? Am I going to redeem? So for me to decide that, I should know the value of the conversion, right? So if share price increases by 4%, what's going to happen, right? Now, if share price increases by 4%, that means now, when can I do this conversion? They said an alternative to redemption in 8 years is we can convert in 7 years time. So if the share price is going to increase by 4% every year, I need to know, okay, after 7 years, how much will the share price be? Okay. So currently it is 6.5 per share. They told me that as well. Right. So what I will do is, I'll say the current share price is $6.5. If prices increase by 4%, then share price in 7 years will be how much? 6.5 into 1.04 to the power 7. So in 7 years time, share price will actually be 8.55. Okay, if the share price increases by 4%, right? Now, what are they telling me? In 7 years, for every loan note that I have, I can get 110 ordinary shares. So if one share is worth 8.55, the total value of this conversion will be 110 into 8.55, right? So conversion value is 8.55 into 110 shares. So how much is that? Conversion value is $940. Okay, $940. Now, what do I compare this 940 with? If the conversion value is 940, how do I decide whether I'm going to convert or whether I'm going to redeem? If I convert, that means for every loan note, I will get $940. That is very clear. Okay. The other option that I have is I can redeem, right? I can redeem. And how much am I going to redeem for? Nominal value. They said redemption is in 8 years time. At nominal value, meaning $1,000. So now tell me, am I going to convert or am I going to redeem? I have loan notes. I have two options. I can either convert or I can redeem. If I convert, the value I will get per loan note is 940. If I redeem, in 8 years time, I can get $1,000. What will you do? You will redeem. Is that what you will do? No. Okay, then what are you going to do?
I won't convert. I will.
What?
I won't convert.
Okay, why? Because redemption, you're going to get more. Is that what you're saying?
Convert the dollars, the dollar will be, loan note will be 940.
Yeah, if not, you're saying it's 1,000. It is valid, but there is a small problem here. Conversion is 940 correct, but you will get it in 7 years. Redemption is 1,000 correct, but we're talking about 8 years. When it's financial management, first of all, the time has to be at the same point. So if you're talking about conversion that's happening in 7 years, you have to consider redemption that is also in year 7 steps, right? So this 1,000, we have to make it in 7 years time. So meaning we have to bring it back by 1 year, right? So they told me that I think the cost of debt They told me it was current cost of debt is 8%. So what you do is go to your present value tables, go for 8%, check what the discount factor is for 1 year. So we can bring it to year 7 steps. Okay. So let's go ahead and do that. In year 8, two things happen. Like Yumna is mentioning, yes, you do have the $1,000 plus in that particular year, there will be an interest portion also. So you can't forget that, right? So if you take the interest portion and you look at the question, if you look at these convertible loan notes, we're talking about 7% per year, right? So 7% into nominal value of 1,000. So 7% into 1,000 will be 70. Okay. So don't forget that. Plus 70. So that will be 1,070. This you multiply by with the discount factor at 8% for 1 year, right? So that will be 0.926. So in year 7's terms, the redemption value will actually be 990.8. It will be 990.8. But whether you figure this part out, right? Whether you figure this part out or not, the answer still remains the same. Because if you see conversion, you're getting 940, redemption, you're getting 990. So still you will go for the redemption option only. You won't go for the conversion option. Okay. So in your exam, even if you don't catch this, it's okay. You might lose a mark or two. The remainder will just be the same. Okay. So now they're asking you, okay, fine. You have decided we are going to redeem. So what we will do is let's get the market value they say. Okay. So let's go ahead and get the market value. Right. So it will look like this. If there is a 4% increase, so we have our years. Year naught will be the market value. Then year 1 to, since we are going to go directly for redemption, we have to consider 8 years. So here you have the market value. Here you have your interest payments. And then you will have the redemption. Okay. So market value. Okay. In this case, they're asking itself for the market value. We don't have it. So let's calculate it this way, right? So interest was how much? 70. Redemption will be 1,000. Right? So then take the discount factor at 8%. So if you look from year 1 to year 8, 8% annuity factor will be 5.747. And year 8 discount factor will be 0.540, right? So now if you get the present value and add it up, that will be the market value. So total. Right? So this is only the market value. If share prices increased by 4%. So let's put headings here. Okay, so same thing you have to do if the market prices increased by 6% as well. So then maybe we will not go for redemption. Maybe we will go for conversion in that case, but you have to calculate and only decide. Okay. Yes, Afzal, but in the TUTE, the conversion and the redemption both happened in the same year. So even if you keep the interest separately or not, doesn't matter, because end of the day, we didn't bring a year 8 to year 7 in any of our TUTEs. No. So in this question, there is a small change, because what's happening? The redemption is happening in the redemption is happening in 8 years time, conversion is happening in 7 years time. So everything that happens in year 8, you don't have a choice, you have to bring it back to year 7. So in this case, since that 70 was also a cash flow happening in year 8, we have to bring it to present value. In others, most other 99% of the questions, you won't have this situation. Why? Because we will be comparing both in the same year. Redemption, conversion, both will happen in 1 year. Here, unfortunately, it's happening on a previous year. So that's why we have to consider the interest component separately and the redemption separately. Okay. It is specific for this question. Yes, but it is an important point, right? Because you have to understand why that change happened. It happened because of the fact that the redemption and conversion, their years were different. Otherwise, it doesn't matter, because end of the day, everything is happening in year 8 now. But like I said, when it comes to your exam, there are certain questions that will differentiate a very good student with a good student. Okay. Now, a very good student, an excellent student will identify that, okay, this 1070 has to be brought back to present value. But just because you miss that doesn't mean you will lose the mark much. Okay, that 1000 plus 70 into 9.26 into 0.926 will only probably give you a mark or 2 at max. Okay, so the entire question is worth how much? I think 6 marks. You will anyway, you are eligible for about 4 to 5 marks. It's just that one extra mark to differentiate a really good student. That's about it. So even when you're doing the revision kit, don't get put off if you miss these small things. As long as you can do the main things, you'll get more than, half the mark that you need. Get it? And in this case, even the market value and all won't change, because the decision doesn't change. But even if market value changed, decision change doesn't matter. The examiner will give you your carry forward marks. You can see here, Afzal will ask me, right? Year 1 to year 8's interest I have included it. It's not like I haven't. It's just that it has come in the previous part. I'm not putting it over here. Okay, it is there hidden, but in this particular situation, we had to properly take it out and include it in the redemption as well. Okay, right. So let's see what's going to happen if the share price increased by 6%. So if share price increased by 6%, right? So actually the share price today was how much? 6.5. Okay, so that will be 6.5 into 1.06 to the power 7, because obviously conversion is happening in 7 years time. So conversion value, how much? 9.7. Okay, that into the number of shares that we can get per loan note, which they told me was 110. So total conversion value is 1075 per loan note. Okay. Now compare this with that same 990.82. Okay. So in this case, what's happening? Conversion is giving me more. So in this case, I will go ahead and convert. I won't redeem. Okay. So conversion, remember again, it happens in year 7. So don't get the years wrong. So years 1 to 7, you will have interest. And in year 7, there will be the conversion. Okay, so the interest was 70. Conversion is 1075. Discount factor at 8%. Discount factor or annuity. Okay. So annuity factor for interest will be 8% for 7 years, which is 5.206. And the discount factor for 7 years will be 0.583. So market value, sum of this, it is 991.15. That's it. We just ask for the market values if share price increased by 4% and 6%. That's it. Okay, take it down. Okay. Right. So that will be your 6 marks there. Then they say, discuss the limitations of the dividend growth model as a way of valuing ordinary shares of a company, right? Now, whenever you see a question like this, have a habit of quickly, writing down the equation for dividend growth model. Okay. So, okay. This is the equation. If you look at the equation, you'll get ideas. P naught is D naught times 1 plus G over KE minus G, right? So what are the many assumptions that we make here? First assumption that we make is that this growth rate will be constant. Okay. Then the way we calculate growth also, we extrapolate past dividends and assume that the old years, the pattern is going to continue to the future, may not happen in real life. Okay. Then we assume that this P naught, market price of the share that we have calculated, that is correct. If it is not a listed company, then that will be an estimate. Okay. That's another thing. Cost of equity, we are assuming it will be constant, whereas year on year, it can keep on changing, right? So those are the things that you can just mention, okay? The assumptions of basically the dividend growth model, right? So let's have a look at what they say. 539. Okay, so here it says, the dividend growth model values the ordinary shares of a company as the present value of its expected future dividends. And the model makes the assumption that these dividends will increase at a constant annual rate. So they're just giving a small introduction. Then they're saying future dividends can't be known with certainty and dividends do not increase at a constant annual rate in the real world. So first problem is we can't assume that the growth that we are calculating will be constant forever. So that is the first point. By the way, when you're reading theory based answers, do look at what is highlighted, right? I know you can't see the highlight on your screen, but in the revision kit, if you see, actually, it will be highlighted in certain areas. Just read that. You don't have to write everything that the examiner is saying. Okay. Then it says, the DGM also assumes that the cost of equity is constant in reality, cost of equity will change as economic circumstances change. So that's all they have highlighted. So whatever is highlighted is the one that they're looking for. So that's what I said, always write in short sentences and make your point very clearly. So the examiner can give you 1 mark for 1 point. Okay. So if you mention that, you should get your 4 marks, right? So if you look here, this is the marking scheme. See, D part, assumption of the constant dividend growth rate, you get 1 to 2 marks. Assumption of constant cost of equity, you get 1 to 2 marks. Any other relevant discussion, you get another 1 to 2 marks. But anyway, maximum is only 4. Okay. So this is how you know, when you do a question also, when you're marking it, have a look at this marking scheme and award yourself the mark accordingly. Okay. Right. So that's it for plan company. Yes. So that's what I had planned for the day. If you guys have questions, you can ask me now. Right. So let's go to the contents a bit.
What about the fiscal policy and all? Do we need to consider too much for that?
They won't ask you to write or anything. If at all, it will come in a MCQ. So don't worry too much because that is an economic thing, no? So very rare for them to ask.
Again, working capital, cash management, inventory management and all.
Those are important. Those are important. Okay. Right. So hopefully next week we will do some more questions to do with working capital management. So at this point, guys, I have now this first part, financial management function and environment, you don't get in section A much. You can see the only question they have is some JJG company. Last they have asked in June 2009. Okay, very rare to get that area. So let's do a few questions to do with working capital management. Investment appraisal, I have done 2 main things. One is the NPV calculation and the lease versus buy. But you have to make sure that you do the remaining questions. For example, I'll give you some important questions that you need to try definitely. You need to do Degnis, Raxin, Pelta, Ding, and Cabreras. Okay. 280, 281. Degnis, Raxin, Pelta, Ding, and Cabreras. Okay, so make sure you do all of them because when it comes to investment appraisal, they can ask you the NPV itself, a lease versus buy, or they can even ask you the effective annual cost. Okay. After that, other things also there, sensitivity analysis, expected values, those things can also be questioned, right? So do give a lot of importance to this investment appraisal question. Then when it comes to business finance and cost of capital, most of these other questions will be similar to the other 2 questions we did today. So it will be very similar to COF and Z. Okay, but again, when you're doing questions, start from down. Okay, start from the more recent questions and then go to the older questions. Don't waste time with something that came in December 2007, June 2007. All of them are too old. Okay, so stick to the newer questions, right? Business valuations also, thing is business valuation, usually they will connect it with cost of capital. Okay, so for example, we did ZMO, we did COF. In both, sometimes we had to do a calculation of market value, no? So that's a little bit of business valuation. Okay. And risk management, the only proper past paper was plan, which we have already done. The others are, again, it will be like a revision because most of the time risk management comes in section B. It doesn't come in section C. Okay, so that's the reason why you can see there are not many past paper questions for that particular area. Okay, so since we have time, let's quickly do a few section B questions. So this is to do with risk management. Like I said, most of the time risk management comes as a MTQ, right? So look at Noon Company. It's on page number 100. Okay. Yeah, let's do that. Read through it and see if you can get a part. Okay, so it's saying here, Noon Company, a company based in Centerland, whose home currency is the Centerland colon, has been regularly buying components from and selling finished products to businesses in Flyland, where the currency is the Flyland franc. Okay, so we are in Centerland, our currency is CC. We are actually dealing with the Flyland franc as well. One particular payment of 3 million Flyland francs has to be made by Noon to a supplier in Flyland in 3 months' time, and they have the following information: spot rate and the forward rate. And they are giving you the interest rates as well. So chances are that you have to do a money market hedge, because if not, they won't just give you interest rates there. Okay. What's the cost in central and colons for the forward market hedge? Right. So it's a payment of 3 million Flyland francs. I am in Centerland. I don't have Flyland francs, right? So what do I have to do? I have to buy this from the bank. That means the bank is doing what? Bank is selling. Always the bank sells at the low rate. Okay. So if you look at the forward rates, 3-month forward, 6.321, 6.362. Bank sales low, so it will be 6.321. So that will be the conversion. So 3 million divided by the lower rate, which is 6.321. So we'll end up paying 474,608 colons. That will be answer B. Okay. 474,608. So that's answer B. Okay. B is saying, which of the following relationships attempts to explain the difference between forward and spot rates of exchange between two currencies and the relative rates of interest between the two currencies. So if you are trying to connect the forward with the spot rate and interest rates, we are talking about obviously which theory? Is it the expectations theory? Forward rate, spot rate, interest rates. For example, purchasing power parity is future spot rate, current spot rate, inflation rate. So where do we have forward, spot, and interest rate in the equation? Interest rate parity. Okay, so it is the interest rate parity theory, where the forward will for F1 equals to S0 times 1 plus the interest rate of the counter currency divided by 1 plus interest rate of the base currency. Okay, so answer there will be C. What is the cost in central and colons of a money market hedge? So asking you to do a money market hedge for the payment of 3 million Flyland francs. Okay, so second time we are doing a money market hedge today. Can you quickly finish that off? Okay, so let's do the money market hedge one more time. So what is the transaction we're talking about? We're talking about a payment of 3 million Flyland francs in 3 months' time. So in 3 months, we have to pay 3 million Flyland francs, okay? Payment. Payment means this is a liability. So today you have to do the opposite. You will have to create an asset. So creating an asset means two things can be done. Either you deposit or you can borrow. Borrowing is a liability. So here you need to deposit. Now go to the question and see deposit rate for Flyland francs. It's 13.5%, right? They've given it there, 13.5%. But that's the annual rate we only need for 3 months. So I'll multiply it by 3/12. Okay. So today what's going to happen? I'm going to deposit the present value of 3 million. So 3 million divided by 1 plus 13.5% into 3/12 will be 3.375%. Okay. So today I will go ahead and deposit 2,902,056 Flyland francs. Yes, that's today. Now, I am based in the other country, right? The CC country. Now, in this country, I don't have Flyland francs to just deposit like that. So, I need to see in my currency, in central and colons, how much this 2.9 million is, right? So, I will convert it at the spot rate. So, what happens now? I need to deposit now. So, if I have to deposit, I have to buy these Flyland francs from the bank, right? So, if I have to buy, that means the bank has to sell to me. Bank always sells at the lower rate. So if you look at the spot rate, lower rate is 6.170. So that will be the amount that the bank will give me. 6.170. Okay. So when I do the conversion, it should give me in central and colons 2,902.56 divided by 6.170. So it should give me 470,349 central and colons. Okay. This is in France. Right. So now what will I do? I will borrow this amount. Okay. So I deposited, I'm supposed to deposit first. So the second thing I will do is I will borrow this. So go to the question again. See the borrowing rate for central and colons. So if you look there, borrowing rate for central and colon is 8.1%, right? So that will be the rate. But again, this is annual rate. So take for 3 months, 3/12. Right. So finally, how much will I have to borrow? 470,349 into 1 plus 8.1 into 3/12 will give me 2.025. Okay. So ultimately, I'm talking about 479,874 central and colons. That is only the answer. So to pay this 3 million in Flyland francs, I will end up incurring a cost of 479,874 central and colons. Okay. So that is the money market hedge. The answer there will be D, actually. D. The money market hedge, guys, is always this. Okay, so only practice will make you get the hang of it. Otherwise, the structure is always the same. And you can see actually doing this only gives you 2 marks, right? Why that's the case is in FM, we don't consider money market hedge to be complex. Okay, that's why when we do the money market hedge, we only get 2 marks for it. If you do it, I think, I'm not sure if we do it in MA. I don't think we do it. We just talk about it. But there is a point where we feel, okay, money market hedge is actually complicated. And in that case, they'll give you 5 marks or something. But by the time you come to FM, this is considered a simple calculation. When you go to AFM, it's even more simpler. When you get money market hedge, it's like that question is an easy question. Okay, so don't think that, okay, there is a lot of calculation, so we can always expect 5 marks. Not the case. Money market hedge, usually 2 marks, 2 to 3 marks. Okay. Take it down if you have one. Okay, right. So then let's look at the next one. C is done. D is saying indicate by clicking in the relevant boxes whether the following statements on the characteristics of interest rate futures are true or false. They're talking about interest rate futures. Okay. So first statement is saying amounts and periods are standardized. Is that the case? If it's a future, is the amount and the period to maturity standardized? It is standardized, right? That's why we sometimes say we can't get 100% hedge because we have certain specific blocks. We have to, do the hedging in that multiplication only. Like for example, if it's a currency future, it should be in blocks of 62,500 pounds. Okay. So yes, it is standardized. And periods also, maturity happens in March, in June, in September, December. If you go and try to finish off the deal somewhere in February, you won't get 100% hedge. That is also true. The amount as well as the periods are standardized. So first one is true. Second point is saying they are legally binding contracts. Are they legally binding? Yes, if you enter into a future, you say you buy futures, you have to sell it after that. You can't just forget about it. If you sell futures, you have to buy. So if you started the futures deal, it is legally binding for you to finish off that deal as well. Okay, so that's also true. They can be bought and sold on a secondary market. It's true, right? Primary market means new securities like shares. The company is issuing a loan note. This is not like that. If you want, you can buy it from somebody who has already bought a future also. So secondary markets is where you trade futures. They can be used both to hedge risks and to speculate on interest rate movements. Definitely, we know that it is used to hedge risks. And for speculation means it's like this. Some people, if they feel that the interest rate is going to move favorably for them, then they will try to get the positive thing out of it. Okay, now it's like this. If you take a future, when the interest rate increases and you make a profit out of the transaction, say, you will make a loss in the futures deal. Now, for a normal company, they're fine with that. They don't want variation, so they're happy with that. Net impact is 0. But some people, what they do is they try to make profits out of future deals as well. Okay, so speculation is where you want to make a profit because of the fact that the future has moved in such a way that you're going to make a monetary profit. So yes, we do use it in speculation also. So that is also true then. Okay, so all of those 4 statements are correct. He is saying if inflation is currently running at 3.8% per year in Centerland, what to the nearest 1% is the implied inflation rate in Flyland? So they've given me the inflation in Centerland. They're asking me the inflation rate in Flyland. Now think what equation can you use to figure out inflation rates? What do you think you can use? What's the equation that connects the spot rate with an inflation rate? Think that way. Sorry? So yes, you have to use purchasing power parity theory. You have the spot rate. I tell you, I know that the purchasing power parity says the future spot rate equals your current spot rate, but you can make an assumption that the forward rate and future spot rate is the same. So based on that, how will you get the inflation of the other country? They're saying that inflation in the base center land is 3.8. They want to know the inflation in the counter. Okay.
No. No. Box.
Yeah. Right. So let me. Okay. So I know that they're talking about inflation. So definitely I have to use the purchasing power parity theory. Okay. So they're talking about inflation. So I will use the purchasing power parity theory. So let me go there. First thing is always write the equation, right? It always helps you. Purchasing power parity theory. We're saying the future spot rate will be current spot rate times 1 plus inflation in the counter currency over 1 plus inflation in the base currency. Okay. Now, we know the future spot rate. This is updating. Okay, I have the okay, doesn't matter. I have the future spot rate, which was the forward rate, which is 6.321. Okay, so that will be 6.321. And the current spot rate was 6.170. Then they told me 1 plus counter currency was what we need to find. So I'll just put it as HC over 1 plus the inflation in the base currency, which was 3.8%. Okay. But be careful here, right? Because this spot rate and this future rate, they are 3-month rates. Okay. So inflation also, you have to put it as a 3-month figure. So into 3 over 12. That's a mistake that students do in this question. Okay. So then it's just a matter of rearranging this equation to get your answer, right? So that should give you how much? Let me see. Yeah. So what you need to do is basically get the answer for this part, this denominator, get that answer, and then you multiply this side by that answer and 6.321 by that answer. So it will cancel each other off and then divide it by 6.17. That answer minus 1. Okay, so I hope you know how to rearrange an equation. So let's take HC. That should be 3.4. That will be the answer. But remember, this is a 3-month rate, inflation rate. They are asking for the annual rate. So you need to multiply this by 4 because 3 months means there are 4 quarters in a year. So that will be 3.42 into 4. So that will be close to 14% HC annual. Got it? That's how you will get the inflation in that other country. Okay. Right, so that's it guys for the day. Like I said, next week we will do more questions. Week after that will be the mock. Okay, so next week is physical and online. You can come if you want. The other one will be online. On the 30th, we will be doing the mock online. Right? So yeah, good luck studying. If you have any questions, please reach out to me at any time. That's basically it. So now at this point, where you should be in your revision is basically doing more and more questions. Okay, so as much as possible, increase the number of questions that you're doing during this period. Right? That's it. Okay.